Importance of automated AML tools. Automated AML tools are essential components of modern AML/CFT compliance programs because financial institutions process enormous volumes of transactions that cannot be reviewed manually. These tools support customer screening, transaction monitoring, sanctions filtering, suspicious activity detection, case management, and regulatory reporting. Their primary objective is to identify unusual patterns and potential financial crime risks efficiently while minimizing false positives and operational burdens. The CAMS framework emphasizes that automated systems should be risk-based, aligned with the institution's risk profile, and subject to ongoing governance and oversight. Effective technology improves detection capabilities, enhances regulatory compliance, and supports timely investigation of potentially suspicious activities. Increasing efficiency and accuracy of automated AML tools. Institutions can improve the effectiveness of automated AML tools through model calibration, data quality management, risk-based scenario design, and continuous testing. Monitoring systems should reflect the institution's products, services, customer types, and geographic exposure. Poor quality data, inappropriate thresholds, and outdated rules often generate excessive false positives or cause suspicious activity to be missed. Regular validation, end-to-end testing, and performance reviews help ensure system accuracy. Financial institutions should also assess model assumptions, scenario logic, and parameter settings to maintain effectiveness as risks evolve. Proper governance and ongoing optimization allow automated systems to support both compliance objectives and operational efficiency. Enhanced due diligence and high-risk customers. Enhanced due diligence, EDD, is required when customers present elevated money laundering, terrorist financing, corruption, sanctions, or reputational risks. The CAMS framework promotes a risk-based approach in which institutions apply additional scrutiny to customers whose activities, ownership structures, products, or geographic connections create higher exposure. EDD supplements standard customer due diligence by gathering more detailed information regarding customer identity, beneficial ownership, source of wealth, source of funds, business activities, and anticipated account behavior. The objective is to develop a deeper understanding of the customer relationship and ensure that risks are adequately identified, assessed, monitored, and managed throughout the customer lifecycle. Customers and employees requiring enhanced due diligence. Examples of customers warranting EDD include politically exposed persons, PEPs, customers operating in high-risk jurisdictions, cash-intensive businesses, non-resident clients, entities with complex ownership structures, correspondent banking relationships, trust arrangements, and businesses operating in sectors vulnerable to financial crime. Potential employees may also require enhanced screening when they will occupy sensitive compliance, financial management, trading, treasury, or customer-facing roles. Institutions should evaluate criminal history, professional background, regulatory issues, conflicts of interest, and reputational concerns. Effective due diligence helps institutions reduce exposure to internal misconduct, corruption, fraud, money laundering, terrorist financing, and other forms of financial crime. Tracing funds through a financial institution. Tracing funds is a critical investigative process used to determine the origin, movement, and ultimate destination of money within the financial system. AML investigators use transaction records, account statements, wire transfer data, customer profiles, and supporting documentation to reconstruct financial activity. The goal is to identify relationships among accounts, customers, entities, and transactions while determining whether suspicious activity has occurred. Effective tracing helps investigators understand how funds move through placement, layering, and integration stages of money laundering. It also supports suspicious activity reporting, law enforcement investigations, asset recovery efforts, and regulatory examinations. Accurate record keeping is essential to successful fund tracing. Steps for tracing funds. The process of tracing funds generally begins with identifying the triggering transaction or suspicious activity. Investigators then gather relevant account records, customer information, wire transfer details, transaction histories, and supporting documentation. Funds are followed through each transfer, deposit, withdrawal, exchange, or investment to identify patterns and relationships. Investigators should determine beneficial ownership, identify connected parties, assess transaction purposes, and evaluate consistency with customer profiles. Cross-border activity, intermediary institutions, and high-risk jurisdictions require additional scrutiny. Findings should be documented carefully and escalated appropriately when evidence suggests money laundering, terrorist financing, sanctions violations, fraud, or other financial crimes. Identifying suspicious client behavior. Suspicious client behavior is often one of the earliest indicators of potential money laundering or terrorist financing. The CAMS framework emphasizes that institutions should evaluate customer behavior in conjunction with transactional activity and risk profiles. Customers may display reluctance to provide identification documents, attempt to avoid reporting requirements, provide inconsistent information, or engage in transactions lacking apparent economic purpose. Other indicators include unusual concern regarding confidentiality, unexplained wealth, sudden changes in transaction patterns, and use of intermediaries without legitimate reasons. Behavioral red flags are particularly valuable because they often reveal intent before suspicious transactions become fully apparent within monitoring systems. Common behavioral red flags and detection model. A practical behavioral detection model considers customer actions during onboarding, account maintenance, and transaction execution. Red flags include structuring transactions below reporting thresholds, conducting business inconsistent with known occupations, using multiple accounts without clear purpose, rapidly moving funds through accounts, and resisting requests for information. Customers may frequently change instructions, use nominees, avoid face-to-face interactions, or demonstrate unusual urgency regarding transactions. Additional concerns arise when clients engage in complex activities with no apparent business rationale or when account activity deviates significantly from expected behavior. Combining behavioral observations with transaction monitoring and risk assessment strengthens the institution's ability to detect and investigate suspicious activity effectively.